Hello, welcome to EGN 3613. Most manufacturing companies would like to invest in adding a new production line or buying a new machine. The problem with that these machines will lose their value over time. Actually, even on the personal level, if you decide to buy a car, as soon as you sign and drive the car out of the dealer, it will lose some kind of a value. The car or the machine will lose money due to what's called depreciation. In this session, we are going to address the depreciation concept and look at the different factors to consider when depreciating assets. In addition, we will discuss the different types of depreciation. Depreciation is the loss of value for a fixed asset such as a car. So if you purchase a car that's worth $15,000, by the end of the first year it will be already $5,000. Loss. So the value of the car will go down from 15 to 10. Actually, as soon as you drive out from the dealer lot, you will lose $2,000 to $3,000. The depreciation will continue over the years, but the lost value will decrease. As you can see here, from 5,000 went down to 2, and then from 2 here went down to 1. So the older the car or the machine gets, the lost value will decrease. Companies have to consider depreciation as a part of the business expenses, which will reduce the taxes that a company pays on the depreciation or depreciated item. So we have to add the cost of production, operation, and depreciation as expenses that might be subtracted from the gross income to calculate the total taxable income. Then we subtract the taxes to get the net income, or what's called profit. The economic depreciation can be calculated by subtracting the market value from the purchase price. The amount of loss in the price will be due to both physical depreciation or deterioration and technological obsoleteness. The calculations will be through allocating cost bases over a period of time. This figure depicts the breakdown of depreciation from economical and accounting point of views. The accounting depreciation will break into book depreciation, that's to develop financial reports, and tax value, which is depreciation used by the IRS. The factors that we need to consider when calculating the depreciation value is the period of time for the depreciation, the disposal value of depreciated item, the depreciation basis and method of depreciation. Examples of assets that can be depreciated are assets used in business or held for production of income, assets having a definite useful life and a life longer than 1 year. Assets that must wear out, become obsolete, or lose value. Actually, a qualifying asset for depreciation must satisfy all of 3 conditions above. So it's not one of them. Actually, all 3 conditions have to be satisfied. The cost basis of an item will equal the actual invoice price plus all shipping and handling fees, the installation of that item on site, and the site preparation. All that is considered an initial cost, or what's called cost basis, that must be used in depreciation or depreciating the depreciation calculation. If we were to consider the trade-in allowance and it was higher than what we anticipated in this case, if you look at the table, you expected 4,000 and you got trade-in allowance of 5,000. Then using the book value, you get the difference between the trade-in and the book value, which is 1,000 in this case, and that's called unrecognized gain. Unrecognized gain. This is what you expected, this is what you traded in, and the difference, which is 1,000, that was unrecognized gain. You did not expect that to come. That's why we need to subtract that from the total, and instead of having the $68,875, then we got the $67,875. Determining the service life of an asset is very difficult. The uncertainty of these values triggers a dispute between taxpayers and the IRS. To solve the problem, the IRS published the asset depreciation range guidelines on lives for different categories of assets, which allows the taxpayers to choose a depreciation value within the specific range. The table on this slide shows an example of the different categories and their allowed range. Let's take one example. You can see for the buses, the lower limit is 7 years and the upper limit is 11 years. The midpoint life is 9. So you can claim the least when it's 7 years and the maximum when it's 11 years. And you can look at the other categories or the other assets as needed. Now let's go back to the 2 types of depreciation. We said that depreciation is book depreciation or tax depreciation. So the book depreciation, which is used in reporting net income to investors, stockholders, and in pricing decision, while the tax depreciation is used in calculating income tax for the IRS and in engineering economics. There are 3 methods to calculate the book depreciation value. We have the straight line method, we have the declining balance method, and we have the unit production method. In the straight line method, it provides a service in a uniform fashion over the item's life, and in this case the annual depreciation will equal to, of course we had D for depreciation, will equal to I minus S divided by N, and it's constant for all N. The book value, B as a book value, is equal to I minus N multiplied by D. where I is equal to the cost basis, the initial cost, S is the salvage value, and N is the depreciable life. And that's the whole life cycle for the item that we are calculating the depreciation for. Now with small n, that's the year after year changes. So year number 1, year number 2, year number 3. If it's 5 years period, then n is 5. That's a constant value, 5. It will not change. That's the total life period. Let's take an example so we will understand more about how to calculate depreciation. In this example, we are to calculate using the straight line method, and the values that we have an initial value of $10,000. We have salvage value of $2,000. This is the initial value. This is the salvage value, and that will be over a lifetime of 5 years. So n is equal to 5. Now I can calculate the depreciation using the formula. So D is equal to I minus S divided by N. I is 10,000, so 10,000 minus 2,000, that's 8, divided by 5, that's 1,600. So every year we are losing 1,600. That's why we can say that the initial value 10,000 minus 1,600, that's 8,400, minus 1,600, that's 6,800, and so on until we reach to year 5. So the value at the book value at year 5 will be $2,000. So using this value, we can calculate the book value over the 5 years as shown here. The second method is the declining balance method, which provides a service in a decreasing fashion. So the annual depreciation in this case will include a factor alpha that will be between 0 and 2 multiplied by 1 over n. If alpha was chosen to be the upper limit, alpha is equal to 2 multiplied by 1 divided by n, then we will call it as a 200% double declining balance. Double declining balance when alpha is equal to the upper limit or the upper bound. So the book value B will equal to 1 minus alpha to the power n. Let's look at an example also for the declining balance method to understand more how it's being calculated. And again, we have the initial value as $10,000, n is equal to 5 years, and the salvage value is $2,000. In this case, D is equal to alpha multiplied by B, n minus 1, and B is equal to the initial value multiplied by 1 minus alpha to the power n. Based on using the upper limit for alpha, so alpha is equal to 2 multiplied by 1 divided by n, then alpha is equal to 40%. If we multiply the book value 10,000 multiplied by alpha 40%, that's 4,000. 10,000 minus 4,000 depreciation will equal to 6,000, and so on until we get to year 5. As you notice here, we got 2,000, and in the previous calculation we got 2,000 as a book value for year number 5. So whether we are using the straight line method or the declining balance method, actually we are getting the same results, and this is how we get the book value. We can find a relation between the declining balance and the straight line and switch between the two as shown in this example. So that if you look at that, you will see that the depreciation rate, which is 1 over 5, that's 1 over n. Based on that, alpha multiplied by the double declining book rate or book value, which is equal to 200%, multiplied by the straight line rate. And if you multiply 1 over 5 multiplied by the 200, then you will get the 40%, which is the same calculation that we got before. So what is the benefit of switching from the declining method to the straight line method? If you calculate the depreciation using the or without using the straight line or without switching, at the end you will get a book value of 778 based on multiplying the 40% with the value that's that will be left once you subtract. So we have 778. While using or switching to the straight line will take whole advantage of the tax deferring benefits, and then you can claim that as tax, and at the end the book value will be 0. So instead of having to pay at year 5 tax on 778, actually you will not be paying any taxes, because you can claim it as this item is 0 value and should not pay taxes on that. If we have a salvage value of 2000, we notice that the law does not permit us to depreciate assets below their salvage value. So once you reach the 2000, even if you would like to depreciate and say 2000 minus whatever the value is, 40% multiplied by the leftover, it will not give you that value, because now it will be sold, or you can sell it with 2000. If you can salvage that and get the 2000, then you cannot claim less than that. In the third method, which is the units of production method, we are going to use the unit of production to calculate the depreciation. And in this case, the annual depreciation D will equal to the service units consumed for a year divided by the total service units multiplied by I minus S. And again, to understand more, we can look at one of the examples. In this case, I is equal to 55,000, and I is the initial cost. The salvage value, or S, is equal to 5,000. The total service units is equal to 250,000 miles. The usage for this year is equal to 30,000 miles. So the depreciation is equal to 30,000 divided by 250,000 multiplied by 55,000 minus 5,000, and that will equal to 3 over 25 multiplied by 50,000, or as final value depreciation will be $6,000. So after the first year, the value will be, instead of 55,000, will be $49,000, and so on. That will be all for this session. If you have any questions, you can email it through Falcon Online. Thank you.